Another thing that you need to remember, here we had 5 years and the coupon paid once a year and the market interest rate was 11%. But what, for example, if we have 5 years but the coupon is paid semi-annually? So in this case, instead of payments, you will have 10 payments. And then this interest rate must be adjusted downward. You need to divide it by 2 and you will get 5.5%. So therefore, these factors, discount factors, were obtained from the table where the row is equal to 5 years and the column is 11%. But if we have 10 semi-annual payments, then you need to look at the row equal to 10 years and the column equal to 5%. And also if it is a quarterly, if it is 5 years and coupon payment is paid quarterly, then you will have 5 times 4, 20 coupon payments, and the interest rate would be 11% divided by 4. I think it is 2.75%. And so you need to look at the appropriate row n equal to 20 and the column r equal to 2.75%. So it all looks logical. So you borrowed $12.5 million. Then after 5 years, you pay them back $12.5 million and you pay the regular interest coupon payment. So all looks logical. But this situation, when you borrow 12.5 million and investors pay you 12.5 million now, and you return this 12.5 million after 5 years and pay these coupon payments, this situation will happen only if market rate is equal to the coupon rate. For example, 9% market rate and coupon rate 9%, or 11% and 11%. But in our case, it's not that thing. We have coupon rate 9% and the market rate is 11%. So therefore, investor will need to think carefully. So if investor puts his money somewhere else in the market, he will get 11%. But if he buys this bond by the Dodgy Finance, he will get only 9%. So therefore, it looks reasonable for him not to buy these bonds and do something else with his money and buy, for example, shares or put money in the bank account. Right. But still, what if he decides to buy these Dodgy Finance bonds? If he decides to buy Dodgy Finance bonds, he will be willing to pay for these bonds on 1st of April 2010, not 12.5 million, but less than that, 11 million, for example. In other words, to induce him to buy the bond that giving low interest rate, the only way to induce him is to offer him discount so that he buys now at price lower than 12.5 million. And the opposite, if the coupon rate was 15% and the market rate was 11%, then every investor would like to buy that bond because it offers more return than elsewhere in the market. And in this case, there will be competition between the buyers of these Dodgy Finance bonds, and they will be willing to offer higher price. So therefore, on 1st of April 2010, they will be willing to pay more than 12.5 million. In this case, the bond will be sold at the premium. But in our case, so 9% coupon, market rate 11%. So what we're going to do? We're going to use information from this column. You multiply 12.5 million principal by 0.59, get 7.4 million, the present value of the principal, and then you will multiply the coupon payment by the present value annuity factor, 3.69, and we'll get the present value of all 5 coupon payments equal to 4.1 million. And then you add them together, and that's the present value of principal and the coupon payments, 11.5 million, and it is less than 12.5 million. Why is it less? Because the coupon rate is smaller than the market rate. But if the coupon rate, as I said, was 14% and market rate 11%, then the present value of principal would be much larger and present value of coupons would be much larger, and the overall value here would be more than